Good morning. Following on from Friar's energy trade setup video, there's a question: how much does each trade actually cost? How long do I hold it? What exactly do I do? And that's the right question. It's the only question that matters once we have the macro thesis. So today Friar will go through the 4 trades in a bit more detail. Okay, why oil right now? We'll just go short reinforcement. Fact 1, 14 million barrels per day gone. The Strait of Hormuz closure removed 13% of the global oil supply. For context, Russia-Ukraine removed 3 million barrels in a day and pushed the oil price of the paper oil price to 130. The current crisis is at least 4 or 5 times larger, and the market is still not pricing it in yet. Fact 2, stocks running out. Emergency reserves and commercial stocks are being drawn down at record rate. Jet fuel and diesel are approaching minimal viable levels, and when those run out, prices must rise to reduce consumption. That is simple supply and demand, not speculation. And I'm sure you've all been hearing that numerous airline companies are cancelling flights outright due to shortage of jet fuel, price of jet fuel. Fact 3, price must go much higher. The Economist interviewed commodity economists a few days ago, May 2026. The rule of thumb range to destroy 13% of oil demand, the amount that's been lost, is between $167 and $460 per barrel. That's the mathematics. Current Brent at 111. The gap between 111 and 167 is the market still pricing in a quick resolution. What these academic economists called La La Land. Oil futures traders are living in La La Land. So we're not speculating on oil going up. We're actually positioning for the market to stop being wrong. Structural disruption is real. The price is not yet reflecting it. The paper price. As I've mentioned, the actual spot price on the day for available oil is around $150 plus. Fact. So our defined risk spreads profit even if oil stays broadly supported, which given the supply shock is our base case. The trade structure. 3 steps. Sell a put. You promise to buy Oxy shares at $57.50 if the price falls there. The market pays you for making that promise. That payment is the premium you collect. In this case, around $1.56 per share. Next, you buy a put at a lower strike. You protect yourself by also buying the right to sell at $55. This caps your worst case loss. No matter how far Oxy falls, your spread width is fixed. Pocket the difference. You collect $1.56 per share and you paid 60 cents per share. So the net credit is 96 cents per share. That 96 cents is your profit target. The maths, 1 contract, 100 shares. Net credit, 96 cents times 100. So that's $96 target profit per contract. Spread width, $57.50 minus 55 is $2.50 spread width. Maximum loss, $2.50 minus 96 times 100, $154 per contract. The GTC, which is good till cancelled order. The moment you are filled, you place a good till cancelled closing order at 48 cents. Exactly half your credit. Do not watch it, do not manage it. It fires automatically when the spread loses half its value, which is your profit. A common question: why are we selling a put if we think oil is going up? Shouldn't we buy calls? Fair question. However, selling put spreads in a high IV environment collects richer premiums than buying calls. We profit if Oxy stays above 57.50, which it will as long as our oil thesis holds. The defined risk spread structure means even if we are wrong, we know the exact dollar loss before we enter. Okay, we'll start with OXY, Occidental Petroleum. The maximum profit per contract, $96. Maximum risk per contract, $154. Expected hold time, approximately 7 days. That we're looking to get a 50% profit close. Actual expiry, July 17, 2026, 77 days to expiry. Why did we choose the strikes? The 57.50 short put sits just below the current price, $58.71. It's in the money by only $1.21. The 55 long put sits near the 50-day EMA. The algo's put floor is $45.99. Our spread is $13 above the algo's worst case estimate. That's our cushion. The important Buffett point. Warren Buffett's Berkshire Hathaway owns approximately 28% of Oxy. Buffett has publicly indicated a willingness to own more. This creates a de facto price floor. Institutional buyers step in on any meaningful weakness. It's been reported Buffett's willingness is at anything below $60. This makes the $57.50 short put even safer. Why the double diamond signal matters. Friar's algorithm fires a diamond signal when multiple technical conditions align simultaneously. Stochastics resetting from overbought, MACD histogram expanding, trend confirmed. A double diamond is on consecutive sessions, April 30th and 1st of May, is rare. In the historical database, it has a very high win rate. This is not normal. So enter with full conviction, 4 contracts. Well, that's what Friar will do. So 4 contracts, 116 total capital risk. So that's $154 maximum loss times 4 contracts. The target profit on 4 contracts, 96 times 4, $384. But we close at 50%. So the target is $192, and the target time frame is about 7 trading days. Chevron, CVX, target profit for contracts 50% close, $192. Expected hold about 7 trading days, and expiry 17th of July, same again. Okay, there's been a fresh MACD bull cross. This is the highest quality signal in this group. The MACD histogram crossed from negative to positive on the 30th of April, and that was the first time in several weeks. A fresh cross from below zero with the histogram expanding rapidly is a high probability setup. CVX has more room to run than Oxy. RSI at 82 versus Oxy 54. The spread, short $185 put, which is currently $5.62 below the current price. Buy the $172.50 put. Spread width $12.50. This is wider than Oxy's $2.50 spread, which means the max loss per contract is higher. It's about 1,154 if fully lost. However, the probability of reaching $185 is very low given the bull cross and the 20-day EMA support and the fundamentals. I might add at this point, Friar watched an interview earlier this morning with the Chevron CEO, who stated, amongst many other things, that he expects that the oil market will become under a lot of pressure very soon, and he is very surprised it hasn't already. Okay, next one. A capital note. Always check the spread and the bid ask, obviously, before you actually take the trade. If you have questions, let me know. Now, Friar's view, CVX is the most interesting setup of the four, precisely because the MACD cross is fresh. Fresh signals at this configuration historically produce the cleanest runs. The RSI at 48 means the stock is not overbought. There is genuine room for the thesis to play out before any technical resistance. USO, the US Oil Fund ETF. This is one that Friar follows closely. Okay, I'll just start right at the beginning. USO is an ETF. It tracks the price of crude oil directly. There is no earnings risk, no CEO risk, no single company event. If oil stays supported, which Friar's macro thesis says it must, USO stays supported. Okay, why USO has the best liquidity? An ETF with this much daily volume has the tightest bid-ask spreads in the options market. That means, A, you get filled closer to the mid-price, B, the good till cancelled close orders fire efficiently, C, there's less slippage. For a first trade, liquidity is everything. Again, recommended USO. The spread, short put near $132 to $135 near the 20 EMA, which is at $132.34. Buying the put near 118 to 120, which is near the 50 EMA. Current price $42.80. The short put is at about $10 below the current price, meaning USO must fall 7% before your short put is tested. The MACD signal. USO has the strongest MACD histogram of these four. This means oil ETF momentum is the most robust. The stochastic has reset from 97.6 to 78.6 in 2 sessions. Healthy cooling that creates re-entry opportunity. Friar's recommendation for spreads and others that are just starting or just looking into the options market. This is USO is the one to start with. It's got the liquidity, clear price target, absence of single stock risk, and direct oil exposure make it the cleanest expression of Friar's thesis, with the most forgiving fills. VLO, Valero Energy. Important, do not enter VLO yet. The signal says wait. The momentum indicator is at stabilizing. It has not confirmed a full reversal. Friar's doctrine is clear. The signal confirms before the capital deploys. Why VLO is compelling when it does fire? VLO is a refiner. Refiners benefit twice from Hormuz disruption. One, the crack spread widens as refined product prices outpace crude input costs. And two, US refiners face less competition from Gulf product exports. VLO's MACD histogram is expanding the fastest of the group in the last 3 sessions. The spread when confirmed. So sell the 230 to 235 put and buy the $210 to $215 put. Spread width is around the $20. This is the widest of the 4. Max loss per contract 1,904. That sounds large, but the algo's put floor, $198.82, is $48 below the current price. The short put at $230, $235 is $12 to $17 below current price. So why the wait matters. Entering before the momentum confirmation increases the probability of the trade working against you in the first few days. The extra patience costs nothing. The opportunity does not disappear. You are simply waiting for the momentum indicator to show stabilizing on Friar's spreadsheet output. That is the green light. When VLO confirms, enter the same way as the others. Sell at the mid-price, set your good till cancelled at 50% immediately and hold. The compounding engine slide shows VLO as week 4. We should have by then several successful closes under our belts. The next few slides I'll let you read. You can put it on pause and read, and then ask me any questions on Discord or directly. I want to make this a bit quicker. Okay, the conclusion. I'll go to Ed Sekoda's surfer quote, which you see often on my slides. The way to look at it, I think, futures day trading is chasing small waves constantly. Option spreads on structural macro theses are waiting for the big wave and riding it with patience. Okay, yeah, that'll do.